Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, stocks failed at new all-time highs last week, and with the market undeniably expensive, it's more important than ever to be picky about what you buy. I'm following the money in the AI theme to highlight 5 tech stocks with returns from 27 to 94% to my price targets, and one that could 10x long-term. I'll count down to that one tech stock to buy along with important updates to shares of Palantir and SoundHound AI. But first, if you've ever wanted to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and then they'll email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link below. Back to our main topic, and I highlighted a few weeks ago the sell signals flashing red for this market, but also why the bull can keep charging for another year or more. Stocks are undeniably expensive, with those in the S&P 500 index trading for a price of 22 times those earnings expected over the next year. That is 21% more expensive than the 10-year average, and several sectors are trading even more expensively. But you don't even need to go into the fundamentals to see that stocks are struggling here. Just looking at a chart of the S&P 500 and you see, after a 23% run in the past year, stocks have struggled to move higher for 3 months. Now, it doesn't mean you need to rush to the safety of bonds and cash, but it does mean you should only be buying the best stocks, those with the highest upside conviction. And in this market, tech stocks are where you want to be if the bull keeps running higher. Shares of the iShares Expanded Tech ETF, the ticker IGM, have jumped 32% in the past year, easily beating that broader S&P 500 index, and even the tech-heavy Nasdaq with its 27% return. Tech companies are expected to post nearly double the earnings growth against the broader market over the next year. Tech stocks in the S&P 500 are expected to see profits jump 22% over the year, compared to growth of just 13% for the 500 largest U.S. companies. Only stocks in the healthcare sector even come close, with their 19% expected earnings growth. But even within the tech sector, not all stocks are going to be screaming buys, and valuations have made it extremely important that you stay picky. The average price to expected earnings for tech stocks in the market index is almost 29 times price to earnings, or 35% more expensive than the 10-year average valuation. This is the most expensive sector, but also the one with the highest upside on growth, so I want to highlight the 5 tech stocks in each of my favorite themes, counting down to the one tech stock I'm buying above all the rest, my 10x pick. We'll start here with Broadcom Inc., ticker AVGO, my favorite right now for that all-around data center growth. We'll be following the money in artificial intelligence for these first 4 stocks, but from different themes, different angles, highlighting stocks dominating a specific part of that big picture AI trend, before highlighting my 5th stock, one that is revolutionizing its trillion-dollar industry. Now, if you've been watching the videos, you know that data center build-out is one of my focus themes over the next few years, with JP Morgan forecasting spending by just those top 5 hyperscalers, that's Amazon, Microsoft, Alphabet, Meta, and Apple, to reach $1 trillion by 2027. And while we'll drill down into specific components for the data center boom in our next stock, nobody encompasses the entire infrastructure like Broadcom. AVGO provides the entire stack from switching, protocol, custom silicon, and chips built specifically for artificial intelligence. The company's Tomahawk 5 and Jericho platform supports tens of thousands of AI accelerators with balanced, congestion-free networks. And within storage, Broadcom's storage area network solutions dominate the industry with its adapters and switches for those high-speed, lossless transfer. Growth of 18% this year is expected to take the company to $61 billion in revenue and $6.35 in per-share earnings. Like most in the space, Broadcom is not cheap at about 20 times on a price-to-sales basis, but that leadership across those core data center components is going to get it a big share of that trillion-dollar spend and keep this one growing fast. My $283 target price over the next 2 years is based on 2026 revenue of $75 billion and a slightly lower multiple of 18 times revenue, a 27% return from here. More specific in that data center theme, for the massive networking upgrade coming, I like Arista Networks here, ticker ANET. Last Friday's video highlighted the next big crisis coming to growth in artificial intelligence. It's not cheap AI from China and not the chip supply crunch we've seen over the past year. It is the massive upgrade needed to the nation's networking infrastructure. This is the critical plumbing that allows that data transfer between storage, users, and servers, and those pipes are starting to burst. Straits Research forecasts the global data center networking market to grow from $34 billion to almost $120 billion by 2033, and BNP Paribas expects the market for just networking switches to quadruple. And while Broadcom holds its own here as well, Arista is the data center switching leader, specializing in the kind of high-speed, low-latency networking gear that AI needs. Its EOS software is a key differentiator, offering better programmability, automation, and scalability compared to Cisco's legacy systems. Its AI spine switches handle multi-petabit data speeds, and the 7800R4 scales out 50 times for larger workloads. Arista here has even stronger growth than Broadcom, with sales up 35% over the past 3 years, and a 20% pace expected this year and next to $10 billion at 2026 sales. Valuation is a little better too here at 19 times on that current price to sales. My target for $180 per share is based on that $10 billion in 2026 revenue times the same 18 times price to sales valuation for a 38% return from here. Next here, we're following that money in AI to the use cases, and none are as close as Salesforce Inc., ticker CRM, with its lead in agentic AI. Now, Salesforce reports earnings this week, so we're going to get more guidance, but the first real use case for artificial intelligence is in those AI agents, and CRM is already leveraging that growth. While generative AI and some other use cases may still be years away, Grandview Research estimates the current market for agentic AI at $5.4 billion, and growing at a blistering 45% rate to $52 billion by the end of the decade. Salesforce has been developing its AI agents for years and is now at the right place at the right time. General Mills was recently able to triple its engagement with customers through an AI assistant set up through Salesforce, and that same success can be replicated across industries. The CRM has the slowest growth on the list, and I wouldn't normally get excited about something with a 9% sales growth, but I think those forecasts are grossly underestimated on that advantage Salesforce has in that agentic AI and this growth in this theme. Shares trade for 8 times trailing sales booked, but fairly cheaply on a forecasted revenue. Now, my target for $412 is based on 2026 sales of $45 billion and a 9x price to sales multiple, 33% return, but should go even higher as that growth in agentic AI builds. The best value in AI, and even across tech stocks right now, is Advanced Micro Devices, ticker AMD. Now, this is a break from those first 3 stocks, which are dominant players in their part of the AI theme with strong competitive advantages that will drive growth. Now, AMD isn't the leader in chips. That obviously goes to NVIDIA with its 90% market share of the AI semiconductor market. But the valuation and the growth on AMD makes it one of the few easy buys right now. But this is not just about a cheap stock though. AMD 300 series, especially the 350 upgrade launching this year, will feature a 35x performance increase to stay competitive with NVIDIA chips in that data center build-out. AMD's strategic acquisitions of Pensando and Xilinx also gives it a play in that networking theme. Pensando brings its data processing units, or DPUs, enhancing low-latency, high-performance networking, directly competing with NVIDIA's Bluefield. So given these competitive strengths, some even against NVIDIA's dominance in that AI theme, it just doesn't make sense that a company growing revenue by 20% plus a year is trading for just 7 times on a price-to-sales basis. No expected revenue of $32 billion this year makes it even cheaper at 5.7 times sales, at least a 40% discount to the 8x valuation it was at just last December. My price target for AMD of $360 per share is based on a 2026 forecast of $40 billion in sales and still a cheap 9 times price-to-sales valuation. A 94% return, and it still wouldn't be expensive. And my favorite tech stock right now, a stock most likely to be that next 10x return, Symbotic Inc., ticker SYM, revolutionizing the logistics robotics market. The shares here have recently fallen on disappointment that the company only posted a 35% sales growth over the last year. A perfect example of the market setting impossibly high expectations and then selling a great long-term growth story. Symbotic is using AI-powered robotics to automate the trillion-dollar warehouse and logistics industry, with just the installation of its systems worth $432 billion market, and the operational side another $500 billion plus. This company has grown revenue by over 600% in the 3 years through fiscal 2024, with another 31% annualized growth expected through 2026 to $3.1 billion. And a few points here lead me to believe it can keep posting that growth to dominate its industry. First, it's already starting with a $23 billion backlog of revenue, nearly 10 times its current revenue and orders, and add to that another $5 billion likely after it acquired Walmart's robotics business to handle the world's largest retailers' warehouse and delivery robots. But surprisingly, this is another one trading cheaply at a price of just 8 times sales booked over the last 12 months, and even cheaper against some of those forecast revenues. On the 2026 sales target of $3.1 billion, shares of Symbotic are just 4.9 times on that price-to-sales basis, which is cheap for a company growing at a 30% plus pace a year. But here, while my 2-year target of $52 per share is a 103% return, You want to hold on to this one while it revolutionizes warehouse and logistics. Even a fraction of that trillion-dollar warehouse market, and it could get a big chunk of that just on its Walmart partnerships alone. But even a fraction would be worth tens of billions of dollars in revenue and 10x this stock. Now looking at the stocks I'm watching this week, first up, IonQ, ticker IonQ, reports its earnings on Wednesday, with the shares up 189% over the last year, even as quantum computing stocks come off their highs. I highlighted the company in December, revealing that Amazon owns over 1.9 million shares worth $61 million, for just under 1% ownership of the company. IonQ is positioning itself to be the leader in quantum computing, the next generation of processing speed, and a market it estimates to be worth as much as $850 billion by 2040 across everything from AI to cryptography. And while quantum stocks plunged in December when NVIDIA's CEO said the technology is still 15 years from viability, there have been breakthroughs lately that point to a much sooner timeline. While IonQ is expected to double its sales to $83 million this year, though, it is still trading ridiculously expensive at 88 times full-year revenue. So while that long-term opportunity is immense here, you need to be ready to wait out the growth and give this one time if you're going to be investing, because there's going to be a lot of ups and downs along the way. I'm also watching SoundHound AI, ticker SOUN. It's going to be reporting its earnings on Thursday after crashing nearly 50% last week when NVIDIA reported its updated 13F filing that it had sold its 1.7 million shares of the company. Now I'm preparing a full video on the changes, but I don't think it means what investors think here. We saw NVIDIA also drop its shares of Serve Robotics and NanoX Imaging, while only adding Nebius Group and WeWrite Inc. From the amounts, it seems NVIDIA is really only buying shares in companies to help develop a partnership and provide capital to those new companies. Once the companies have succeeded in their industry, like we've seen with SoundHound AI, then the boost is no longer needed and NVIDIA pretty much moves on. SoundHound has inked multiple partnerships over the last year and is still expected to double its sales this year to $164 million. Their shares still aren't cheap after the pullback, though, trading at 26 times on that price-to-sales multiple, but neither are they expensive for a company doubling its sales every year. I would be a buyer on any dip here as SoundHound continues to prove that it's going to dominate that $160 billion market for voice AI. Advanced Auto Parts, ticker AAP, also reports its earnings on Wednesday and continues to be a deep value play waiting on news. Activist investors won board seats last year to shake up the company, and Advance has been selling off its non-core assets to pay down debt. While revenue is expected lower by 6% this year, this is still a strongly cash flow positive company, generating over $200 million in free cash flow over the last 12 months. Debt is still a problem, but is being paid down and at an enterprise to revenue valuation of just 0.54 times, the company is ripe for an offer from private equity that could be as much as 20 or 30% higher than the current price. Dell Technologies, ticker DELL, is scheduled to report its earnings on Thursday, and it's going to be an important read into the data center demand for servers. Now, Dell's growth in the data center component is clouded in its other segments, especially laptops, which are seeing weak demand right now. But the company is still expected to report 10% sales and 14% earnings growth for the quarter. In the past few weeks, while growth has still been very good, companies like SMCI and AMD have underperformed their expectations in their data center components. Their shares of Dell here aren't particularly cheap at 0.92 times sales, especially given just a 9% full-year sales growth expected, so I would limit my risk on the company. If the shares do drop on bad news, I might reevaluate here, but I prefer HPE and SMCI in that data center server space. Palantir Technologies, ticker PLTR, could have a very important week after plunging 18% last week as it waits for more news on the Department of Defense budget cuts. Shares fell in the news that Defense Secretary Hegseth had given Pentagon officials until February 24th to outline plans for cutting the defense budget by 8% in each of the next 5 years. Some of Palantir's core areas like cybersecurity will be exempted from cuts, but shares still will be volatile and could fall again once we get a concrete plan on what will be cut. While commercial revenue is the growth driver for the company, government sales continue to be that bread and butter at 2/3 of the total revenue, and spending discipline at the Pentagon is going to dampen that segment's 24% growth. Palantir was the stock to own last year, but the market hates uncertainty, and even with that 18% drop, shares aren't anywhere close to value territory here. I'd feel better here around an $80 price point, but be avoiding the stock until then or until we get news on that Pentagon budget. Showing you that bigger picture here with the SectorSpiders.com sector tracker. 5 of the 11 stock sectors closed higher last week, proving there are opportunities even in a sell-off. Traditionally safety sectors like utilities, consumer staples, and healthcare all did well, along with energy stocks that have rebounded from those oversold conditions over the last few weeks. Consumer discretionary stocks could be the canary in the coal mine, though, falling last week on fears that a return of inflation and a weakening economy would hit consumer spending in the things that they can kind of do without. We'll be coming into more earnings reports from retail companies like Nike in the next couple of weeks. Watch what these companies say for trends and outlook in that consumer spending. Stocks in the real estate sector rebounded early last year as the Fed lowered its rates, and it looked like there'd be some reprieve to the massive sell-off we saw in 22 and 23. Real estate stocks posted double-digit returns when the rate on the 10-year Treasury fell below 4% in September. With that run back up in interest rates, though, now stuck at around 4.5%. Stocks in the sector have fallen 0.14% over the past 6 months and are back to flat over the past 5 years, by far the worst performing sector. There is still a lot of value here, though, waiting to be unlocked when interest rates do come down. Real estate stocks have produced a 10% annualized return over the last 15 years, so when rates do start coming down, look to this group to rebound again very quickly. Favorites in the group here include telecom properties like Crown Castle and American Tower, data center names like Digital Realty, along with others like Vici Properties and Ventus Inc. Get your free report and see the stocks I'm buying for the next 30 years, my forever stocks, free with the link in the description below. Or click on the video to the right to see the 7 penny stocks I'm buying for 2025. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.